This is our Forex blog for August 17th, and like we do most days, the first step of our easy three-step Forex trading system. And we have many different methods that are more sophisticated than the ones I show on the Forex blog. But for new traders, this is a way and a method you can learn in 1, 2, 3 days and know how to trade while you learn some of our more sophisticated methods like support resistance, position sizing, Fibonacci analysis, Fibonacci clusters, support resistance clusters, how to count waves and know when the trend's likely to end, how to use all of our containment bands, range projection tools to know when trends have gone statistically too far and likely to end. But for new traders that don't want to learn all that, or at least not right away, the key is catching bigger wins and having smaller losses. And by measuring each currency statistically to every other one, like you see here, you can see the real-time trend on the dollar on the top. This is made up of 5 of our best statistical tools, which we average together. Nobody can look at 2, 3, or 4 indicators at once and make sense of all of them, so we average it together. 3 of them measure the direction that the dollar's moving, up or down versus all the rest, and 2 of them measure the intensity of that direction. Underneath that, we have the 15-minute trend, hourly, daily, weekly, and monthly. So the more time frames that line up, the easier it is. You can see quite a strong euro earlier in the day, and then it starts to get weak. And anytime you see a lot of weakness, and then with the counter trend move, shows visually about half the strength compared to the weakness, that's a trend that's likely to go down. It's even more likely to go down if the hourly trend, daily, weekly, monthly are down. So looking at that, the one that had the most time frames down was the Australian earlier today, and you'd trade that against either the dollar or the yen. You can see the yen earlier today was still in a downtrend. The daily, weekly, monthly trend was down, whereas in the dollar it wasn't. So you'd want to sell the Australian dollar. It's that simple. And looking at our range chart, we have our value areas of the previous day. The yellow line is where most trading activity happened yesterday. Above that, price tends to go up. Underneath that, price tends to go down. The upper and lower value areas, which is where yesterday it spent 68% of its activity, is in this tight range right here. Above the green upper bound upper value area, it's likely to go up. Underneath the red one, it's likely to go down. And these oftentimes give you good breakout trades, and they occur before oftentimes the previous days or high or low. As you can see, here's the previous day's high, whereas the upper value area is right here. The lower value area is right here. Sometimes it's 20 or 30 pips away from the previous day's low. And most of the time when it breaks out of one, it breaks out of the other, and it lets you get into a trend early. So this was a clear downtrend. You can see extreme weakness. The counter trend move had no strength, and basically you're looking to sell it. Once it goes underneath the lower containment band, it's more likely to reverse. This is a workspace that I haven't updated for a while. We have new tools that are faster. One of those new tools is using the digital signal processing based containment band. So you'll see once I put this on there that the white band will go down further because it's much faster with the current trend. And the red one I will do as well. And so basically underneath these levels, you're likely to get a little bit of a reversal once the momentum dies out. And you can see it had a nice little reversal here, and then it came down, hit the much faster 1.5 band, and that was the end of the move. These are great places once they get to, especially the white bands, once they get underneath there, any signs of it running out of steam, you might want to get out of that trade. Also, I'm trying to make trading easier. Here's a new tool using just the color candles that can help new traders intuitively visualize which pairs to be in, when to get in, and when to get out. Here's the Australian dollar using a new statistical trend tool I've developed that shows mostly intensity. And you can see really the start of the downtrend happened last night right here, and it pretty much kept you in all the way down. There was almost no dark green bars whatsoever. And again, there's 2 ways to get into these trends. Once you identify a trend that's likely to continue, like the Australian dollar was one of the better ones starting the day out to be in. There's 2 ways to trade these. One, look for a pullback, which is basically once the market's gone down a little bit, 20 to 50 pips, wait for a 10 to 15 pip or up to 25 pip pullback, and when it breaks that trend line, you go short. Another one is a little sideways rectangle pattern, which when the market goes sideways from about 20 minutes to maybe 2 hours in a nice little rectangle pattern, And when it breaks that, it's also one of our two main entry methods. And a lot of traders might just simply do what I'm doing now, is putting on a moving average on your chart, but it's not a normal moving average. It is using our new digital signal processing, which is very fast. This is the same kind of technology that's used to clean up digital signals in your MP3 music and CDs and so forth. It's very fast, it's very clean. As you can see, it takes price and it's just sticks with it. I'm using a 5 period, shifting it 2 bars to the right. And you can see, just like where that trend line was, when it broke, it's pretty much right there. You see that? Now I like to see, once the market's moved down a lot, I usually like to wait for at least a 38 to 50% retracement. Sometimes you're not going to get that. So I will kind of give it 2 chances to go up to this level. If it fails, a lot of times I'll sell this one. If this is the beginning of the trend, I'll sell the first pullback. Like if this had been going sideways and this was the first move down, I'd sell it here. But you can see it went down, sideways, down, sideways, down. It's 3 waves. It may only move 1 more wave down. So I want to be a little bit more cautious in selling it the next time, which is right here. And you can see the first one right here didn't really go down. It may, at that point, retrace all the way back up. If you just simply, when a currency goes too far, just wait for 2 attempts to go higher. If it can't, usually the second time you're going to get a good trade. You can see this fell about 15 pips. Now somebody asked me how I made a comment without showing proof that if you get just 10 pips per day, you double your account every 2 months. So I will showcase what I mean by that. In our software we have position sizing trade analyzer tool, and it lets you do what if calculations. Obviously position sizer, if you have a $2,000 account and you want to risk 2% of your account on any given trade, and for new traders I recommend 1%. Decent traders 2, and sometimes I'll go up to 4% on trades that I think are about 80% likely to work and likely to give me 30 pips. So most of our trades, when they don't work, you're going to lose 10 pips or less, a lot of times 6 or 7 pips, break even, so forth. We're not going to scale in, but this is very sophisticated and lets you scale in the trades. And you can see with a $2,000 account, with risking 2% of your account, you can trade 4 mini lots with a 10 pip stop. If you are using wider stops, guess what? You can only trade half as much. So going to the planner, you have a $2,000 account and you get 10 pips per day, pretty much every 2 months, you can see the account doubles. And this is the trade size that you're doing. Another 2 months, you have 8,000. Another 2 months, you have a little over double that time, because we're not incrementing this. It's not going to 1.81 lots or 1.86 lots. We're incrementing it in 1 mini lot increments. But you can see at the end of the year it grows to an astronomical amount. It's basically 130 times bigger in 1 year, getting just 10 pips per day. So somebody asked the question today in an email. I think I wrote him back, and the email bounced. So hopefully he watched the video today and he can see how I came up with that. So this is the first example. Now there's another tool I'm working on that I'm going to be releasing sometime next week, and it is a very amazing tool. I'll show it to you right now. Bringing up a Australian dollar chart, 2 days, 5 pips per bar data. Just like we use the previous weeks and the previous days value area, we now have the ability to do the same thing intraday. So intraday value areas, this is the 4-hour. I also like the 60-minute. It lets you see where most traders have positions during the previous hour or 4 hours. Whatever time frame you want, really. It works on any time frame. We go and get tick data, do the calculations, and this shows you. So you can see not only did it break down from the value area of yesterday, it was also the value area of the previous 4 hours right there too. Notice it's underneath the value area pretty much every bar. This is the first time where it got above the value area, and I don't really take into account, sometimes markets will open above the upper value area and sometimes they penetrate them. So you really need to wait for a penetration. It penetrated the value area here, it went down 15 pips. Notice how it acted as resistance. The most actively traded price for the previous hour was right here. And this is a wonderful tool to kind of let you know whether to to stay short or attempt a long. Go short again here, it fell. And some traders are going to prefer, longer time frames than just simply the previous hour, and that's fine. The default when I release this will be 240 minutes, 4-hour chart. And you can see the value area. Now, during that previous 4 hours, it went down there and spent most of its time here at the lows. This is the average price. Above that has a chance of going back up, but underneath that's likely to go down, finds resistance. Notice how the next 4-hour period, it goes right up to the value area of the previous 4 hours, and it also finds resistance there, and it falls. This is a wonderful tool for pinpointing your trades. Now let's look at it yesterday. When it's above the value area, it goes up. When underneath there, down, came back up, found resistance. You don't know if it's going down or not. I always wait for it to go below the previous bar's low. When it breaks out right here, you get in, and notice how it found resistance up here at the high. It spent most of this previous 4 hours up here near the high. And these can be near the high of the range, low of the range, or in the middle of the range, because it's using where most traders have positions. This one was near the high of the bar, this one was near the low, this one was near the high, this one was closer to the low. Sometimes they're flat in the middle. You never know. And it's a tremendous tool that I think is relatively simple. Underneath the value area you sell, above the value area you buy, and if you don't want to have the upper and lower value areas on there, just want the point of control, you'll be able to do that in the indicator as well. So I've only done one currency today. Let's go and look for some other examples. Using the currency meter. Later today, the euro got pretty weak. The Swiss also is pegged to the euro, so it pretty much is the same direction. But we'll look for euro-dollar sells. So you could look at a regular chart, or I will bring up just the colored bar chart to keep it even simpler. Now, yesterday, the euro-dollar exploded up. But it spent most of its day down here near the lows, and so this is the value area for the entire day. This is the value area for the previous week. Notice how that is the low today after coming down, coming down. These tend to act as magnets. Now, that being the case, when a currency's gone up so much the previous day, one sign of the trend kind of not working is when it tries to go higher and it fails. That's a pretty decent place to look for the potential of a downtrend. You don't really know it's in a downtrend until it breaks the lows. This was a lower low than before. And again, this is, I'm going to bring up the other charts just to kind of show you this. We'll put the euro dollar on here, and we'll use the 4-hour value areas. First, use a currency meter to identify the euro was weak, the dollar was very strong. You then want to look for sells in this once it breaks down underneath the value area. So really, the first sign of that this might start downtrending was around 340. At 340, it broke down underneath here. So, some trades are going to go a long way and some aren't. It immediately comes back into the value area of the previous 4 hours. And when it goes above here, because the trend was up, you might take a buy. You can see it went up from 60 to 80, went up 20 pips. If you got short right here, obviously you made money. Came back up to this area here. If you went long, guess what? It failed. You get out and you flip and go the opposite direction, short at 55 right here, and absolutely collapses. So one of the keys to trading, obviously, is small losses, big wins. Whether you use our currency meter or not, this is a wonderful tool to help you spot precise entries. Now it's the 4-hour most actively traded price. Now let's take a look at the hourly as well. Obviously, the euro became quite weak somewhere around 6 o'clock right here. And you can see 6 o'clock is about right here. It was up near the highs, and this was the first sign of it failing. Guess what? It came back up to the value area, wasn't able to get above it. Decent place to sell. It fell, and it fell. Notice how it acted as resistance. It fell, came up here and acted as resistance. You might have gone short here with a small loss. And sometimes a new hour starts and you happen to be above the previous hour's value area just because the last move up was up. However, it's clear by looking at a chart that it was a downtrend at that time, and it retraced about 60%. So when it breaks down right here, it's pretty safe to assume it's going to drop, and it's confirmed once it breaks the value area right here. And notice how it also can be used to find counter trend moves. A lot of times the market goes down and it retraces up. This is a 1, 2, 3 low right here. Anytime you have a 1, 2, 3 low where it finds support right at the value here, it's a pretty decent place to get in, and most of the time it's going to make a two-wave move up and stop at the fib target. So you draw your fibs on here, and guess what? Almost to the pip and went to the 1.618 fib target. You would have bought this right here, a pip above the high at 03, went up to 25. So that's 20 pips. That's 2 days minimum net profit if 10 pips a day is your goal, and that one trade all by itself. So these are just a few of our tools and methods. I always like to showcase new things that we're working on to try to improve our trading, improve the accuracy of our automated systems that we're working on. And this is one of the best things I've found, so I'm happy to share with you.